Hello, ladies and gentlemen, and welcome back. Well, I have to say a big thank you to everybody out there. We're about to reach 100,000 subscribers on the channel, and that's thanks to each and every one of you in the community. But in today's video, we'll be discussing one of the most important things when we see a turn in markets. Of course, we've been correct so far as a community with the current run up in stocks. We've also been discussing, of course, the weakness in the US dollar and everything to do with gold right now. But let's break down in today's video what's happening next, because it might surprise you how this could turn out. Stocks around the world are still heating up, but things are starting to get a little shaky here in the futures at the time of recording. See you soon, guys. This will be a good one. Well, welcome back everybody to the channel where we talk about stocks, commodities, and cryptos. Let's begin today before we get into the charts and all the key levels we need to be looking at together. And we'll start here with SP 500 seasonality. So here is mid-cycles between 1928 to present. You'll notice the glaring stats, September being the worst month usually on record during these years. Now, it's a little wonder. We've talked about seasonality of the stock market many times, and we've always hated on September. And so far, it's been a pretty decent run of bad September. But just because you have seasonality doesn't mean it's going to happen. The key is using the technical analysis and other data points to help you prove a point. One thing that has always happened though, or has generally been happening in these presidential cycles, is that while we have this kind of mid into third quarter problem, we often come out incredibly strong, and that actually goes over into the next year. So that could go into 2023. Even with all the problems that we're facing, possibly we are starting to look at bottoms on markets. Here's what a hot July means for potentially late summer to autumn buys. Oftentimes the subsequent second half has been, let's say, a little lower in terms of percentages, and you can see here it's probably a bit cherry picked, this data, but it can often tell you that markets are going towards some weakness, and this just shows that idea of the double dip could be there. Of course, when does it happen? Well, usually it can only happen when everybody stops betting on the decline. Here we've got a chart of speculators widening their net shorts on the S&P 500 futures positions. Now, a lot of these will be stuck very low, so they'll be stuck at prices like 3,600 on the SPY, 3,700 and 3,800, because a lot of people tried to short down there and they've been wrong so far. Effectively, what we're seeing in this stock market is a squeeze against them. Too many people were short. We need them to unload their shorts. Just like what happened here in March into April, we saw an unloading, and that unloading ended up leading into, of course, a nice decline in these markets. That's what you need to have. Not everyone can think something. It just doesn't work at that stage. Midterm election years, just by volatility on the VIX. A lot of people have been betting on the VIX. I've read some of your comments and a few people have been doing that. You're probably a little bit early, but now is the time to start thinking about this concept. I don't personally trade the VIX. I think that it's a very high cost kind of trade, but at the same time, volatility is dropping back into that 21 to 20 level. Historically, August, September, and October have been incredibly volatile during midterm election years, regardless of inflation. Remember, we haven't even talked about this. I don't see many channels even mentioning it. It still is a volatility spike, usually for markets, and that's why they call it midterm election year, traders year. That's why we always thought 2022 together was going to be a traders year, regardless of inflation, because it generally is. In fact, it's statistically likely. Speaking of other statistics, too many people still bearish here on the markets over the next 6 months. You really want that to pretty much drop. And it's kind of like in markets, if everybody thinks something again, too many people then stack into that position, and often the price will manifest against you. And if you don't understand that, a lot of trading is technical analysis, sure, but it's also human psychology and thinking, how can I inflict the maximum amount of pain, or how is the market going to inflict the maximum amount of pain on traders out there? And often that is counter logic to what you often think. 27.7% of people were bullish, 32.2 and 40.1 bearish. We can see the bearish numbers are dropping over the next 6 months, but unless this really starts to flip to the bullish side like we've seen before, there could be still further upside potential here in markets. And of course, we'll see that manifest in the charts. Because we're in earnings, it's important to know your implied volatility stats. You can do this by working out based on options. You'll notice here the implied volatility for AMD, probably the one most of you are interested in, shows at about 7 and a bit %. And these have been fairly spot on so far. PayPal also showing a just under 11% move expected after the earnings results. So big ones here, Starbucks, EA, a few others. Just remember, volatility is good, sure, but do you have the correct risk management in place? Beats rate 67% starting to drop, and this is against very poor expectations as well. Think about this as a catalyst. 67% of companies are beating pretty bad expectations. 756 misses 374. So what that's really telling us as traders and investors is that the market's doing okay, but it's not like fantastic or anything. Remember, it's on low expectations. This is probably more of just an excuse to push it up, say, oh, hey, the beats are okay, but really it's more of a squeeze of everybody thinking that the markets were so bearish, and potentially rightfully so. Time will tell on that one, but can they survive? Remember, markets can stay irrational longer than you can remain solvent. XLP, so one of the most defensive sectors in the market, consumer staples, was out in front, and it was a little bit of profit taking for the last session across a bunch of growth stocks. We also saw this manifest in what happened in the market. For anyone watching the live stream, we always do a Monday open live stream. There was actually a pretty good gap fill trade there. You can go back and watch it. I've still got it up on the channel. Just before around the open, we talk about the structure and what we're expecting. And the market ramped into that. Of course, it did fade near the end and kind of ended flat. At the time of this recording, it's down a little bit again. Could be opening up with another gap down. Doesn't mean it's going to sell off, but certainly we'll be discussing that soon. Earnings moving forward, as we mentioned, some of the higher volatility is coming in Tuesday after the close. AMD and PayPal will both be worthwhile watching. So they're ones that are certainly on the charts and certainly worthwhile checking out. And I guess, look, really that brings us into discussing where we are in the charts right now. The VIX, the volatility index. This is, of course, how people see fear. Previously in 2022 and even previous times, generally when we have gone down underneath 24, we've kind of made it down into this 21 and 20 zone. Now, this has meant that, of course, people are not scared in the market anymore and the volatility is dropping. And that's exactly that time where you kind of think Warren Buffett concepts and you're saying, well, maybe it's time to be fearful when others are feeling a little bit greedy. Well, the VIX traders have come out and they've bought 20 quite a few times and it has worked out for them. We saw a chart a little while ago with the most amount of traders trying to actually buy VIX 40 calls in the future. And of course, that led to a big rally. Too many people betting on this volatility side. Now we're starting to move into around that correct zone. So 20 to 19, 21, all of these areas. If you are a VIX trader, of course, you've got your eye on the prize around that zone. And potentially rightfully so. Here we have a chart of the SP 500 stocks above the 50-day moving average. And notice these three spikes. Let's just have a look at the dates here. So we've got 15th of November. You can check that out in your charts. 3rd of January, 4th of January. Well, we all know what happened after that. We got that big crash beginning. And then we have here the 28th of March into the April period. And of course, we know what happened there. So a lot of stocks have moved up pretty heavily. This is an oscillator. It doesn't mean that the market's going to drop, but it certainly does mean that you're on that kind of top end side. You've got to think about risk reward if you are an investor at this point, or even, no, not so much an investor, but more of a multi-month trader, because it's starting to look a little bit worse on the reward. What are yields telling us? Sickness, just everywhere sickness. We spoke about really peaking of yields over here and most likely the peak of inflation. The bond traders and the yield, they're just hating the economy right now, like 2.53% on this yield. This is just showing you that there is mega inversion going on. So for anyone that doesn't know what that means, is basically when we have a 2-year, which is 2.84 above the 10-year, it means that the short date, that is the date in 2 years, is expected to have a higher interest rate than in 10 years' time. It effectively shows us that the market is expecting recession. Now, that's not really unexpected. Of course, we already know we're probably in a recession in the US, even though they change the terms every second day by voting on it. But the main thing is that when you look at this chart, what is it telling us? Well, it's saying there's a sickness that's probably going to negatively affect oil. That is, oil is going to most likely suffer as long as this is going down. You watch oil fall off a cliff. That's just what happens. And also potentially metals as well are going to suffer. This is a point. Some people are now stating, and I'm not going to state this right now, that the US 10-year could reach 0% or even go negative over the next coming years. That's pretty wild, but that's what people are starting to say. I like to look at it as, what have we got? We've got a break of the support. We've, of course, gone down. At this stage, it's kind of proving the point that there's a sickness, and while the Fed's raising rates, they're probably going to stabilize the rate and then having to cut the rate later on in 2023. How bad does it get? We don't know yet. Of course, that's a bit of guessing. Copper, of course, is reacting negatively to this. It hit our target, which is at 3.55. You can see the box. Go back in previous videos. We haven't changed this box. It is what it is. And it's now, at the time of this recording, breaking through the trend line. So this is not necessarily great news here for any metal out of any of them, really. I mean, we've seen some spikes up in recent weeks, some nice recoveries. Obviously, things like oil as well. This will hurt oil. If copper falls under here and then keeps going down a little bit, expect potential rallies to be met by, of course, selling. Why? Because we have the trend line here. So a lot of day traders are going to come into metals and start really watching around this. Very important point, well worth watching, and of course having on your charts moving forward. Now, we've also seen the decline of the US dollar. So that's kind of led into this idea, well, maybe people are going to start buying growth stocks, and they have so far. And possibly they're even buying certain bonds. And again, that has been a fairly strong trade. Junk bonds, etc., have been doing quite well. But the US dollar basically created what we call like a Wyckoff distribution. We have here what they call like a false maximum pain UT, upward thrust. This area trapped a lot of traders, no doubt, thinking it was going along. And then since then, it's just been making a series of lower highs and lower lows. We are getting close to an area, 104.80, where you could make a case for some buyers to come back in. But really, it's also about adding your weekly 20 moving average to the chart. You've got to remember the weekly 20 is mean reversion. The market likes to come down to these levels. And you can see that here, even with these huge rallies, it's been a while now since it's hit mean reversion. So it's probably due for a pullback. If you put this on, you'll notice over here in December of 2016, we hit that 103.50 area. That's kind of where the 20 moving average is right now. And it could be some further weakness here in the US dollar for a while. And you'll see that manifest in things like the euro as well. Check this out. Here's the euro. Again, lots and lots and lots of movement. The euro has been incredibly weak. The story has been the Eurozone is in collapse and everyone's freaking out and it's under one. Obviously it's under one. And then what do you find? As soon as it goes under that, everyone's freaking out. And then all of a sudden, what? Miraculously recovers. Too many people were talking about it. It's time for a little bit of a pullback. To put this in perspective, again, if you look at it, it's just too far away. And it's been such an aggressive short, it's got to recover. Where's it most likely going to go? Potentially these previous low points. And that sits around, for anyone that's just listening to audio, 103 kind of 75, 80 area. And that's that previous point of supports back due to 2015 and 17. So just pulling back, Fibonacci's are there as well. You can put a fib on, you'll see it all around this area. You've got a whole bunch of pullback circles. So yeah, an interesting point. And again, it just shows that kind of weakness in the US dollar seems to be manifesting itself across a whole bunch of different trades. Gold has also done well. You'll notice here I've got a little bit of a area for gold, ideally looking towards that, making that kind of 1786. Can it get there? It's been an amazing run. On the channel, a lot of you guys have been messaging me saying, hey Tom, I like that level you had before. Hey, well done if you picked it up. Of course, the defended zone from so long ago. This was a cracker level. Very, very good. And yeah, I mean, if you were more of a investor looking at things, gold was sitting on a really huge trend line from back in 2019 and 18. We saw the weakness in the US dollar, and so far it's just been ramping. I mean, this is a fairly big move. Few of you have been trading silver as well. I like to think of gold as this. 95% of the time, it's really tough to trade and maybe even stay away from it. 4% of the time, it's like pretty good to trade, and 1% of the time, it's pretty amazing. And we could be moving into that. Now, I've said that we'll discuss money flow in the future. So I'm kind of thinking something like this is probably how gold's going to trade. It's had this nice ramp in it. It probably tells us that maybe the short sellers have come out, and gold does like reacting to a weaker 10-year. So the more the 10-year comes down, often gold does do quite well off that style of move. I'm not going to explain it here right now, but if you're interested, you can check out our mentoring and stuff. I go into it in great detail. Let's move over to US oil. This has been a tough trade. The geopolitical stuff going on here. Some people say, well, it's pretty easy. I just keep shorting it. Fair enough. We're about to most likely crack below this level. Again, US 10-year weakening, a few other things. Unless they all reverse, we are right on the do or die for oil. And I can tell you the futures contracts are trading down at $84 already in the future. So will we move underneath? Well, it's starting to look that way. I mean, you've got lower highs, and there was a little trade that we thought could go long. So I'll just go back over it because a few of you say, can you look at trades that didn't work out? And I would say this didn't work out. So this was the concept. Basically, you had like a little breakout here. You had potential of the max pain. You had a nice little kind of spring there. It broke, it came down. And the idea was here where it basically went bang, bang, broke through, taking that kind of buy side. And it did go quite strong. I mean, that was a very strong movement up. But then it's come back down, taken out that low. Once that was done, weakness was ensuing. And of course, that's what's occurred so far. So it was one of those trades where it still went up well over 1-to-1. But that was the trigger that we were talking about. And of course, from a technical level, it's failed. Would I take it? Frankly, yes. Would I have lost on it? Potentially. It depends whether I broke even the trade or not. The target was 104. So you got around 60% of the way. That's usually a pretty good level. Around 65% is usually where you want to start break-evening trades, just because you don't want to, of course, give away money if you're in a position. But there's a good little oversight. Let's move over to Tesla. Tesla kind of entered into this resistance area here that we have discussed. A lot of people have the trend line well above for Tesla. I'm not sure if it was going to reach that level, but certainly an interesting one. Rejection here doesn't look great. I mean, that's a shooting star. It was flying during the previous session. I'm sure a lot of people took profit in this area. So if you did, congrats. I'm pretty sure a lot of people would have set 950 as their target. Whenever you're looking at something like a Tesla, remember $50 increments. Try not to aim just for that. Go a little bit before, because so many retail traders trade this stock. Look over here, 1,093. What are people going to be aiming for? 1,100. Think outside the box, guys. If everybody has, you can go look at the level 2 data and the level 1. If everyone's sitting on 1,100 for their take profit, it's probably not a good idea. And Tesla, knowing it's retail traded, you can really take advantage of that. Apple, not quite at the resistance we were hoping for. 165.62 could show us that maybe there's further bullish action here on Apple. Obviously a big gap, so I wouldn't be too concerned for it to pull back here, find buying pressure, and ideally move into a level like this. So Apple's doing fairly strong right now. Big gap though left on the charts. XLY versus XLP, a bit of a reading here from whether the risk is on in the market. Last day, not really too much to be said. It was down. Again, it gapped up. It's gone through the kind of trend line break. We'll be watching this very closely because we've seen it break a horizontal before and it be a false signal. So again, this just shows us risk on and risk off in the market. We'll continue to follow along on that. The DAX broke through the previous resistances. This is all those wicks. Kind of looks like it could be potentially squeezing. The idea is to get it to 13,800. Can it happen? This is the time that it should go down. Small time frames, look for turnarounds, that kind of thing on the next 24 hours. DAX is certainly at that area. IWM, middle of nowhere. 190 has remained kind of that ideal target for this particular market. You can see here the previous resistances and supports, pretty much standard role reversal. Any pullbacks at this stage, it's still in an upward trend. So you would think it's going to be met by buy pressure. But again, we'll look to the SP 500 for that. This is one of the markets we're doing the most analysis on right now here. And this is the Nasdaq. So the Nasdaq's got this beautiful downward trend line. There's the rally in March. Here's the rally right now. Here's the previous support. Here's the resistance. Here's the 50 fib. And you'll notice we tapped it. So we actually just got to it, or pretty much right on it, in the last 24 hours, and then we rejected. So this is a fairly important kind of little point here. We've got the Nasdaq running above this resistance, which is very similar to what it did last time. Remember, it broke that resistance. We haven't quite hit in this zone, but anywhere in here, you've got to say, okay, what's my upside potential? Maybe 2-3% before you hit really critical resistance. What's your downside potential? I mean, at least down to here, yeah? So it's one of those ones where the upside is becoming a little bit more shaky. So you have to use risk management in these circumstances. You've just got to look at it on its merits. Will it smash straight through this zone? Well, probably unlikely considering the trajectory and the amount of gaps that it's left behind, showing inefficiencies in this market. So we'll look over that. Maybe we'll use the S&P 500 for it. So you'll notice here, I've got some gaps. These are all bull gaps. So basically none of these have been filled. It's kind of the same circumstance that we looked at over here when we saw this incredible short that came through in June, and it just split like multiple percentages and just said, whoa. Then we found the island down here. The island trade was amazing. And that then has led to, of course, all the gaps being filled and where we are now. So we've left a whole bunch behind. You would think at some point you want to come down and get at least a few of those. And that's why it's so important that we read these charts. So first up, let's have a look here at the S&P 500. We've obviously got our new monthly R1 pivot. That's sitting around 4,272. We've got a little box up there, previous gap. Notice the gap over here. So there is still one gap left. That's kind of like that extreme bull case scenario right now is around here. We've hit the weekly 20 moving average, which I'll show everybody. There's the weekly 20 moving average. Previously, we have spiked above that. Look over here. But 20 moving average has been a massive support in the way up and a huge resistance in the way down. It's what we call mean reversion. This is what we've targeted for literally a month now. So we've just basically been sitting there saying it's 2020, 2020 is what we're looking for. We're now here. So what do you do next? Well, you have to be nimble and fast in these markets. And that means being adaptable to both sides. Have we seen bearishness? Not yet. Are we starting to see a little bit of a potential coiling market? Yes, we are. So we've got a new high. So it's kind of gone up. We've got a little pullback. We've gone up again. We've got a pullback here. And then we've breached to a new peak. So I've got this little box around 4080 drawn. I think here marks a big change and shift in these timeframes. A lot of people say this could be a double top. Fair enough. They could also say that it bounces off here and it creates an inverse head and shoulders. That could happen. Any of these things could happen. But for now, the market remains bullish as long as it can find bids here, as long as it can find demand buyers to come through in the next 24 hours, 48 hours, whatever it takes. If it breaches underneath the 4080, 4070 zone, then you would think pullbacks should be met by sell demand because we've managed to kind of, show here that we've got some coiling. And the next stop is somewhere around that 4,000, 39.90. Now, underneath that's where the big zone is. This is the really big one. That is the 39.10, 3900, 39.20. This area here, resistance, support. There's so much going on in this level. So at this stage, it's still bullish. There's no reason to say it's turned yet. We have got a little bit of a shift here. So you can see that markets have weakened. Like we just made a new peak. That is the worst peak that we've seen in quite some time. So basically, it made a new high. Did it do it strongly? Not really. So we've got to be very careful about the next 24 hours. And of course, maybe look at these zones and focus in on them. Hopefully that helps a little bit. There's still that real potential. We've got those multiple targets. And what trading is, a few people have messaged to me, what do you think about trading? I would say being adaptable. that is having a bull and a bear case. Even though that may frustrate you, you've got to have triggers to say, okay, I've got to switch my trend, or I've got to switch my attitude. It's hard. It's not easy. It's a little bit hard. Going over to options now, what have we got for the month or the week ahead? So the month's actually still a lot of puts in this market, sitting around 370s and 380s left in from a while ago. We've got a bunch of calls coming through on the 410. So maybe the market would like to be under 410 by the end of the week. Max pain sitting 398. Funny it would be on that zone. And yeah, this is an interesting one. Continue to watch the 410 and even watch how the 420 reacts. It looks like some buyers are coming back into this market and trying to pressure up on the short dates. And that's pointing towards maybe some coiling action between a range here on the stock market. So continue to watch options. That will be a little bit helpful. Bitcoin, as you know, I'm just kind of following along the halving cycle concepts. And obviously, if you look at something like a Bitcoin rainbow chart, it comes up with a pretty okay level. But let's have a look at the charts themselves. And we'll move over here to the daily. When we scroll into the daily, you'll notice it looks kind of weak. So it broke through this previous level. It then pulled up and came back down. There were some buys here that came in, fair enough. But look at this, 1, 2, 3 rejection candles. Yeah, it's not so good, especially with the Nasdaq, which probably leads it, showing you that it's kind of starting to weaken or coil. So be careful here in the Bitcoin buying this dip. I'm not too sure whether it turns at this stage. If I was looking at that chart, a lot of people are saying, was this a head and shoulders? I mean, it kind of looks like one. That could push us easily down to the 22,000. And that would be a level where you would see, okay, are the buyers willing to commit back in this zone? Very careful here in Bitcoin. Ethereum's been the stronger one to trade at this stage, but we'll find out. If you haven't already, come over and follow us on Twitter as well, at FX Evolution. Join our private community, 7-day free trial, link in the description down below. We've got a public trading community as well with heaps of helpful people, great economic charts, over 10,000 of you there. And of course, we have economic news. So remember, guys, we've got the cash rate coming out for Australia. That doesn't affect America too much, but certainly the Australians out there that are watching, it's going to be a thing. JOLTS job openings, 10 a.m. New York time. Then we scroll down, ISM services PMI Wednesday. We have that at 10 a.m. New York time. Then we've got the Great British Pound monetary policy. That could move some currencies out there. And then on top of that, we have the big one, the non-farm payrolls. That's an event that you've got to be careful for. If you haven't seen one before or you've never watched it, just remember that initial reaction often is wrong and then it goes the opposite way. So be very, very careful about non-farms. It's usually a spike of volatility. You often go some way and then the opposite way. So if you're not sure what you're doing, just practice good risk management around that time. Thanks so much to the community as well for supporting us. We're about to hit 100K, and of course, maybe we'll have to do a bit of a celebration in the stream next week. Thanks so much, guys. You have a great day and trade and invest well. See you for now.